Understanding financial statements, P&L, balance sheet, and cash flow. Running a business without understanding your financial statements is like driving a car blindfolded. You won't know where you are going, and worse, you may crash without even realizing it. Financial statements are more than just paperwork. They are essential tools that help you track performance, spot danger early, make informed decisions. Learning objective. In this module, you will learn how to read and understand the three most important financial statements: the profit and loss, P&L, the balance sheet, and the cash flow statement, and how they tell the financial story of your business. A good financial story shows banks you are creditworthy. 1. The profit and loss statement, P&L. Also known as the income statement, this report shows whether your business is making a profit or loss over a period, usually monthly or yearly. Main components: revenue, your total sales or income. Cost of goods sold, COGS, costs to produce or buy what you sell. Gross profit, revenue minus COGS. Operating expenses, overheads like salaries, rent, utilities. Net profit, or loss, what's left after all expenses are deducted. Why it matters, shows whether your business model is profitable. Helps you price your product properly. Banks use it to assess sustainability of your business and whether it is generating a positive return. 2. The balance sheet. This is a snapshot of your business at a specific point in time. It shows what you own, what you owe, and what's left for the owners. Main sections: assets, what you own, cash, stock, equipment, liabilities, what you owe, loans, payables, taxes, equity, the owner's portion after liabilities are deducted. Formula: assets equals liabilities plus equity. Why it matters, shows your business's financial health. Reveals how much of your business is financed by debt versus capital. Used by banks to evaluate gearing and solvency. 3. The cash flow statement. This shows actual money movement, not just profit, but what cash entered and left your business. Main sections: operating activities, cash from your core business, sales, payments. Investing activities, buying, selling equipment or property. Financing activities, loans, repayments, capital injection. Why it matters, a profitable business can still go bankrupt if there's no cash. Helps you avoid liquidity crises. Banks check whether your cash flow supports loan repayments. Common mistakes business owners make: confusing profit with cash, not updating records regularly, relying only on bank balance to judge performance, mixing personal and business transactions. Best practices: use accounting software, e.g. Messenkira, Booku, QuickBooks, or SME-friendly apps. Hire an accountant or bookkeeper if necessary. Review your reports monthly. Learn basic financial ratios: gross margin, net margin, current ratio. What banks want to see. When you apply for financing, the bank will ask for your latest, preferably in the last 6 to 12 months, P&L statements. Balance sheets, cash flow statements, bank statements, to cross-check accuracy. They want to see consistency, positive cash flow, and reasonable profitability. Final thoughts: financial statements are not just for tax purposes or auditors. They are your business dashboard. Without them, you are flying blind. Learn to read them, track them monthly, use them to make smarter decisions, and present them confidently to your financiers. You don't need to be a financial expert. But you do need to be financially aware.